Earlier today, I sat down with Jennifer Sotelo of DSTs 1031 Investments, and we broke down the fundamentals of a DST. So let's take a listen. So Jennifer, the first question I have for you is, what exactly is a Delaware Statutory Trust or a DST?
A Delaware Statutory Trust, a DST, is a real estate investment where a group of investors have the opportunity to own a fraction of an institutional grade property. So it's typically used a lot in 1031 exchanges because you can defer capital gains tax. It's a passive investment, so it's completely run and managed by an investment firm, which is great for people who may not want to deal with the day-to-day responsibilities of an investment, real estate investment.
Okay. Oh no, I think that's a great definition with that. And you normally see DSTs as a replacement property or part of a relinquished property. How does that get involved or started within a 1031 exchange?
So DSTs are typically used during the 1031 exchange process because you can defer your capital gains tax into a DST during the 1031 exchange. The IRS recognizes the DSTs as a tax deferred option.
Right. Yeah, we see it all the time. It satisfies the like-kind requirement on a property or for a 1031 exchange. So yeah, absolutely. So talking about the DSTs, so what are some of the key benefits that make a DST attractive as an option for investors who might be doing the 1031 exchange?
The key benefits of a DST is that one, it's a passive investment. So you have no responsibilities of managing this real estate investment. You have predictable income, so you know exactly what to expect month to month in terms of income. It's also a tax deferral strategy during the 1031 exchange process.
Awesome. So who manages it then? If it's not me as the investor, then who manages that DST?
So an investment firm, which is also called the sponsor, manages every aspect of the real estate investment, all the way from the due diligence of choosing the property, securing the lending, and the day-to-day management of the real estate property, and then also all the way to the end when they sell the property.
Okay. No, that's great. I think it's important so people can see what those benefits are and how it can help them, and from a 1031 exchange standpoint, or rather from an investment standpoint on that end. So because of that, what kind of investors are best suited to be involved in or to invest into a DST? Whether they are doing the 1031 exchange or not, but what kind of investors do you kind of see go for a DST?
The typical investor in a DST is generally one, you have to be an accredited investor. Also somebody who is in a 1031 exchange that's looking for an investment to defer their capital gains tax into. And then the third is usually someone who's looking for a passive investment. So they no longer want to manage a real estate property. They don't want to deal with the day-to-day responsibilities of managing a real estate property.
Okay, so you can kind of see, so it covers a broad spectrum, right? It could be that early investor who doesn't want to manage it or is trying to, found managing properties is hard, but could also be that investor that's late in their age, late in their years, that just wants that passive income coming in, right? Is that those retirees type thing?
There's a very broad range of investors who do invest in DSTs. Really, the basis is you have to be an accredited investor, but we have all different types of real estate investors investing in DSTs, anyone from a modest real estate portfolio who's doing a 1031 exchange, anywhere to a large family office who may be deferring millions of dollars in capital gains tax.
Okay, awesome. No, it's a great, from a 1031 exchange standpoint, it's a great tool that we see, that we always put, the investors, acknowledge, or at least let them know about that option from that end. So, with it being institutional grade properties in the DST, what is that comprised of? Like, what do you see in a DST, or try to explain how that, what makes up a DST?
So DSTs, typically institutional grade properties, but they range all different types of asset classes. So multifamily, senior living, self-storage, medical office, industrial. There's about 90 different DSTs on the market right now. And typically they range every asset class. And one of the benefits of investing in a DST is that you can diversify among multiple asset classes too.
Is that with separate DSTs or is that within the same DST?
So there's different strategies. So typically there can be one DST with one property. There can be one DST with a portfolio of properties, which you'll typically see with maybe a triple net portfolio.
Okay.
Or you can see, sometimes we have investors who are investing over multiple types of asset classes for that diversification.
So you see them going, say, I went a little bit here in this medical office space, and then I went a little bit here in this gas or industrial warehousing space or self-storage space, right? So that's kind of how you see investors investing that way.
Exactly.
Okay.
Exactly.
Awesome. Okay. And then, so can they combine that DST with maybe other properties, such as maybe they want to diversify and say, hey, I still, this DST option is great. Can I still own, the single family rental and purchase the single family rental?
Yes. So that's one of the beauties of DSTs is that there's multiple strategies to use them. So one, you can do exactly what you're saying. So somebody can find a physical like-kind property, invest in the physical like-kind property. Let's say they have a little bit of boot, that leftover amount that they haven't put into that property. That leftover amount can go into a DST. Typically, the minimum for a DST is $100,000. So let's say you have a minimum of that you want to defer capital gains tax. We can take that and invest that into a DST. Another way that people use DSTs is, let's say you do find a physical property that you do want to invest in. You're not sure if it's going to close. Either you haven't secured financing, or the seller may not, something may be going on in that process. And you can use DSTs as a backup. You have 45 days to identify a property in the 1031 exchange process. So let's say you're coming up to that 45 days and you haven't identified a property yet. The
DST would be a great option to fall back on if you chose to try to keep the 1031 exchange alive.
To keep it alive.
Okay, awesome. So what about with financing? How does financing play in? You talk about the boot, the leftover. What if people have to replace debt, on the sale, from the property they sold? So how can financing, and what are the advantages that the DST provides with that financing option, in those type of properties?
So in a 1031 exchange, you have to, find a like-kind property, which means you have to find a property of equal and greater value. That also includes the equity and the debt relief, right? So you have to match the equity and the debt. The beauty of a DST is that there are DSTs with all types of debt. So it's very easy for us to match the debt of your previous 1031 exchange into a DST. So there are DSTs with zero debt, there are DSTs with 80% debt. So we can also, through diversification, mix and match some of those to match your debt going into the 1031 exchange.
So, but what's the benefit of that debt that investors see? The fact that it's, in my understanding, it's non-recourse, correct? So that's one of the benefits that investors see, knowing they have to take on this debt. What's that impact to them?
So there is no impact to them, right? It's non-recourse debt, where with physical property, you are taking on that responsibility of the debt.
Right.
So the investors going into DSTs, on the other hand, are investing in non-recourse debt.
Okay. Oh, so it is a great tool then to replace the value of the debt if they don't want to take out a new loan, or rates are very high considering what they could, what they might have to take out.
Right.
For a new
Yeah,
property.
exactly.
Okay. So how does the DST then generate that income for investors? Like, what does that look like for an investor who's like, hey, I like this self-storage DST. It's across multiple, it's got a few properties across multiple states. What's that income look like to me?
So the income is generated through either long-term leases, through the rents in long-term leases, or let's say multifamily, they're generating rental income.
Okay.
And so the investment firm is managing that and then distributing that income to the investors.
Okay. So how often do you get that income? What does the returns look like on that? Obviously, I know it depends on the DST and so forth. So
Yeah.
what does that kind of look like?
Yeah, it
for the
depends on the
average person?
DST, but typically it's monthly income, which
Okay.
is great for a lot of individuals. And you're expecting somewhere between 4 to 6% depending on the DST.
Okay. And that's monthly. So we call that mailbox money,
Yeah.
I guess is what, people kind of see that as,
Exactly.
coming in, hence the passive investment strategy that might come in where they don't have to actively manage anything. They just receive that mailbox money.
That's one of the beauties
Okay.
of DSTs. Yep.
So what are some of the, obviously we talked about the benefits. What are some of the risks involved with with investing in a DST?
It really depends on the individual, right? The fact that it's a passive investment, some may see that as a negative aspect, right? If you have experience in managing your own real estate property for, let's say, your entire career, and then you decide that you want to go into a passive investment, you're relinquishing that control. So some people may feel a little uncomfortable at first with giving up that type of control. It's also typically an illiquid investment, right? Meaning there's no secondary market for DSTs. So it's not like a stock where you can most likely find a buyer for either higher or lower the stock price, right? There's no formal secondary market for DSTs.
So I just can't sell when the time comes. Hey, I want to sell out of this. I have no control over that. Correct?
Right. So typically you're in the investment for 5 to 7 years.
Okay.
So there are ways that we can find investors to take over your investment if you need to, but we typically don't recommend that as an exit strategy.
Okay. So then, with that, what is the exit strategy with the DST? Is it then just waiting until, I guess, the trustee is ready to sell that DST is ready to go to market and sell, and they have someone come in? What's that exit strategy then look like to me as a investor or someone doing a 1031?
Yeah, so it's handled by the investment firm.
Okay.
They will sell the property at the end of the 5 to 7 years, and then the investor will receive their proceeds back, and then typically there's appreciation that comes with selling the property.
Right.
So the investor will receive appreciation on that investment. And then you can do another 1031 exchange. So
Okay.
you can continue to defer that capital gains tax either into a physical direct property, or you can go into another DST. But
Okay.
you have the decision on how you want
So
it.
the 1031 exchange doesn't end when it sells. Their age, because it is considered a like-kind property in the terms of a 1031. When that goes to sell, that now becomes their relinquished property, and they can do either another 1031 into another property or into another DST when that comes.
Exactly, and that's why it becomes a great estate planning tool, because you can continue to do the 1031 exchange process over multiple generations, and then DSTs qualify for a step up in basis.
Great. We always talk about the 1031 and how it creates generational wealth, how, investors can use that to create generational wealth for themselves and their family. And so that's good, knowing that this vehicle, this mechanism of an investment can continue that, and be passed to their heirs through that step up in basis, and if that occurs from that. So, no, that's great with that. So, what is the role, I guess, that the sponsor plays in selecting the property, for the trust? Are they're obviously doing the due diligence and so forth. What dictates them to determine this property is part of a DST?
Yeah, so it's a very rigorous process. They're looking for quality investment opportunities for their investors. So they will look at every aspect of the property. So they will look at market reports, they'll look at geographical area, even, traffic reports. They'll look for environmental reports, foundation reports. They'll look at appraisals, comps on the property, expenses. So this is, this is what they do. This is their business. They typically will focus on one asset class. So if you're investing in a, let's say, multifamily DST, this investment firm will typically focus on that asset class. So their expertise in that market.
Okay. No, that's great. I think this is very good wealth of knowledge. Not a lot of people know about the DST side of it. So, I think, helping explain a little bit to them about what a DST is, some of the benefits, obviously some of the risks that are involved, as just like with any investment that could come through. This is good. And again, trying to get and make people knowledgeable about this other opportunity that can still continue with a 1031 exchange, help them build that generational wealth, and help diversify, their portfolio, from both, actively managing something to passively managing something, or a combination of both, and allowing that income to help build for them. So no, this is great stuff. Truly appreciate, you coming in, explaining a little bit of the DST. So we thank you for coming out and talking a little bit about that today.
Yeah, my pleasure. Thank you for having me.
And that right there wraps up our video. If you have any further questions about DSTs, feel free to give myself or Jennifer a call. Our contact information is in the description below.